In trading, many things can be interpreted in different ways: structure, patterns, zones. But there is one element that the market always shows: liquidity. In today's video, I want to explain as clearly as possible how to determine liquidity, how it's formed on different time frames, and how to use it to make your trading more logical and systematic. We'll also analyze multi-frame analysis, why it's so important, how different time frames create goals for each other, and why the same extreme can have completely different meanings. Let me say right away, for anyone studying smart money, liquidity always comes first. It's the point around which the entire price movement algorithm is built. It's a trigger, a target, and, in essence, the basis of any ICT strategy. So I hope that after watching this video, you'll not only be able to see liquidity on the chart, but also understand what the market is going to do with it, which means you'll be able to make decisions with much more confidence. I think that among those watching this video, there are some who are hearing the word liquidity for the first time. To help you understand what we are going to talk about, let's start with the basics. Liquidity is traders' stops. This is the basic explanation that is most often given, and in general, it is correct. But the problem is that we cannot see where these stops are. We can only assume that a large pool of liquidity is forming behind the extremes, which the price tends to take. Later, we'll discuss how to correctly determine liquidity, what types of liquidity there are, and where the price really tends to fulfill its goals. For now, it's important to remember one thing. This is how the algorithm works. First, the market takes the liquidity pool. In other words, it runs the stops, and only then moves the price in the opposite direction. This is the foundation without which it's impossible to understand the logic of price movement. Now, one thing is important to understand. Liquidity is not always the same, which means that the market reaction and your goals will also be different. The minute time frame also has its own liquidity pools. They are often referred to as local liquidity within sessions. Such liquidity can also cause reactions, but if you try to analyze only the minute chart, you will simply drown in unnecessary information. It's definitely not worth relying on a single-minute time frame. It can help you enter the market, but not understand where the market really wants to take the price. There is also the liquidity of the sessions themselves, which is usually discussed when talking about smart money. This is the maximum and minimum of the session. And here the picture is different. Liquidity often accumulates during the Asian session, not only in the form of simple highs-lows, but also through the extremes I mentioned earlier on the lower time frame. Such formations are much stronger than normal local liquidity because by the time London or New York rolls around, there is enough fuel concentrated there for movement. The next liquidity zone, which in my opinion is ideal for intraday traders, is the previous day's high and low, or PDH and PDL. To work with this liquidity, you need to see on the chart that the market reacts after the PDH or PDL is taken out. The reaction can be in the form of a candlestick shadow that removes liquidity and reverses, or in the form of a reversal immediately after this liquidity is removed. If the candlestick that takes out PDH or PDL closes with a body below this level and shows no respect for this zone at all, this is a signal to you that this was not the final price delivery. In this case, trying to trade from liquidity doesn't make sense. The market simply continues to move to the next pool. Now let's move on to the liquidity zones that form the narrative and logic of price movement. One such zone is last week's high and low, or PWH and PWL. When such a liquidity pool is taken out and the market respects it, the movement is rarely limited to one day. After the weekly liquidity is taken out, a full-fledged movement may begin, and you can already use the liquidity of the sessions and PDH-PDL of the previous day as targets. In some cases, after the removal of last week's maximum, the price will be delivered to last week's minimum, and this will still be part of the same scenario of executing the liquidity of the higher time frame. Finally, the last pool that is definitely worth remembering is the removal of the monthly fractal. When this removal occurs and the market reacts, the context on the chart can completely change, from long to short or vice versa. This is already the scale that can reverse the entire medium-term scenario, and it's simply impossible to ignore such things in the analysis. I'm listing all these liquidity zones not for the sake of terminology, but so that you can see the simple logic. The higher time frame sets the direction and ultimate goals, while the lower time frames provide the shape and entry points. The market may take out intraday liquidity several times and form local traps, but globally it still tends towards the pools that are formed on a daily, weekly, or monthly basis. And as soon as you start looking at liquidity from top to bottom, from the higher context to intraday scenarios, it becomes clear why the price sometimes ignores local extremes and simply continues its movement. It hasn't tapped the higher timeframe liquidity pool yet. If you don't understand what's happening on the higher timeframe, it's better not to try to switch to lower ones just to get a trade. In most cases, this ends in a stop and a loss of money, simply because you are trading a fragment without understanding the whole picture. Now, when you understand the logic of price movement and how liquidity works, it's time to talk about how to apply this in real trading. I'll show you what I use in my own system. It's important to understand one thing. Every trader who works with smart money may have different trading models, areas of interest, entry points, and ways of reading charts. But the primary factor is always the same: liquidity. Everything else is built around it. To begin with, when you open a chart, regardless of the time frame, the first question should be simple. Which liquidity pool is the price currently following? And what could logically happen after it is taken out? At the initial stage, these are always your assumptions, but they are the basis for building a plan. On the current chart, I mark the liquidity zones from which, in theory, I can see a reaction. The first and most obvious pool is yesterday's PDH and PDL. Just below, you can see another liquidity zone, and it's close enough to PDL, so I assume that the market may take it too. The other liquidity pools are far away, so I just wait to see what happens and watch the price reaction. During the Asian session, there's a withdrawal of liquidity, which I marked in advance. At the same time, it's important how exactly the market takes this pool. In our example, liquidity is withdrawn by the shadow of the candle. This indicates that the zone is significant and can be worked with. And here, I want to give a little advice specifically for this situation. Below, we still have last week's low, and it's not that far away. The price was pushed down quite aggressively, leaving behind an FVG. In this particular case, this is critically important because it's impossible to know in advance how the market will react to this zone of interest. For this reason, I'll show two approaches to trading in such a situation. The first option is more aggressive. We've already seen a withdrawal of liquidity, and the price is showing a reaction to this zone during the Frankfurt session. It is enough for me to see confirmation that the market is not going to go lower. In this situation, the price first falls again, makes a correction, returning the price to the zone below 0.5, and shows a reaction again. At this point, you can already open a trade, setting a stop beyond the extreme where liquidity was withdrawn. The second option is more conservative and, in my opinion, more reliable. You need to wait until the market invalidates the short FEG. In other words, until it shows that the zone is no longer respected as a short zone. In our example, the price closes above this FVG, forming a long FVG. After that, during the New York session, when local liquidity is taken out and the market reacts to the long FVG, you can open a trade with the same target but with stronger logic for entry. Since many people asked in the comments to pay more attention to the entry point on the lower time frame, I explained the logic here. First, the price fell. This movement took it beyond London's local liquidity and simultaneously formed new liquidity from above. After the price was delivered to the zone of interest on the higher time frame and simultaneously to the zone of interest on the lower time frame, we see a reaction and a breakdown of the structure. Then it's simple. I wait for a pullback to my zone of interest and open a trade from there in the direction that was predetermined by working with liquidity and context. This logic works in absolutely any market, but it's important to understand that price delivery looks different for different assets, differently worked out sessions, and intraday time also plays a big role. Don't try to apply this logic to all pairs and all instruments at once. It's much more effective to choose one asset, focus on it, develop an eye for it, understand how liquidity works there, how the price behaves during sessions, and where pools are most often formed. And when you start to see repeating scenarios and feel the details, then you can add the next pair or instrument. For those who find it difficult to analyze all this on their own, you can use the OWL indicator. This is not a smart money tool, but a separate trend indicator that immediately takes into account several timeframes, Fibonacci corrections, and shows ready-made levels for entry, stop, and take. It's suitable for those who are not yet confident in reading context and liquidity, but already want to trade systematically and according to clear rules. If you need some of the work to be automated and not rely solely on manual analysis, OWL can take care of this task for you. I'll leave a link to the indicator in the description. For those who trade crypto, this approach can also be applied to the crypto market. The logic of working with liquidity and the broader context remains the same, but it's important to take into account the specifics. Crypto is not so strictly tied to sessions. Movements can start at any time, and volatility is often higher. That's why it's even more important to first get a feel for specific coins, understand how they behave around liquidity, and only then move on to active trading. Personally, I use the decentralized exchange Evedex to work with cryptocurrencies. It has a simple interface, fast execution, and reasonable fees, without verifications, limits, or unnecessary restrictions. Just connect your wallet, and you can start working right away. If you trade based on structure, understand the logic of liquidity, and want to use your approaches in the crypto market with peace of mind, Evedex provides all the necessary conditions for this. I'll leave a link to the exchange in the description below this video. If you start looking at the market through the prism of liquidity rather than a set of disparate patterns, the picture will become much clearer. Liquidity shows where it's profitable for the market to deliver the price. The higher time frame sets the direction and goals, while the lower ones give the form of movement and entry points. And until you understand which liquidity pool the price is following and what can logically happen after it is taken out, any trade remains essentially random. Liquidity, context, and multi-frame analysis are not just nice words, but the foundation of a system that allows you to consciously wait for your scenarios rather than jumping at every candle. If you found this video useful, please support it with a like. And if you still have questions about liquidity, multi-frame analysis, or the analysis of specific situations on the chart, feel free to write in the comments. Based on your questions, I'll do the next analyses and show even more real examples. Work with market logic, not emotions, and see you in the next video.